So given the current level of public debt in the United States, how difficult is it for U.S. policies to bring down debt now?
The challenge is there enough spending or not? And when there's not enough spending, you have you either tax the money from one group to pay for the other, or you print the money. And so the trade-off really becomes that.
Okay, so prior to the pandemic, you had already warned that we were nearing the end of the long-term debt cycle. So I'm wondering whether the pandemic now has any impact on where we are in the long-term debt cycle.
Yes, it accelerated its movement because you can judge that by the printing of money, the amount of money printed, the amount of debt and money creation. You can't raise living standards by printing money. At the end of the day, you have to make goods and services. That's what raises wealth.
So are you seeing a good, solid recovery in the United States? And what do you think of the fundamentals of the U.S. economy now?
We are in the second, on our way to the third year of the expansion. That's the middle part of the expansion. What that means is that as inflation pressures rise, because there's more money and credit chasing a limited number of goods and services, because there are constraints, that produces a higher level of inflation.
Welcome to SFC Dialogue. We're joined now by Bridgewater Associates founder, Ray Dalio. It's great to see you virtually, Mr. Dalio. Welcome.
Thank you. It's good to be here.
In the next half hour, we would like to discuss one of your most popular works in China, Principles for Navigating Big Debt Crisis, and see how we could use your unique template to analyze the current situation. Does this sound good to you?
Sounds great.
Okay, so the book provides a framework for understanding the mechanics of big debt crisis. You set out 6 stages from the seeds of the crisis to its resolution. So let me be really straightforward. Where are we now? Is the current situation similar to any of the historical cases in the book? And how could we use your framework to analyze the current cycle?
I'm assuming that you're referring to some of the debt problems that are going on right now in China. Is that correct?
And also in the US.
First, there are different ways to engineer manage a debt crisis, which are that there can be defaults and the debt is wiped out. But the problem is that one man's debts are another man's assets. And so when those debts are wiped out, it also means that there is the wiping out of assets and it becomes self-reinforcing. The second way is to restructure those debts. Restructuring those debts means spreading them out over a period of time, spreading out debt service payments, or changing interest rates so that they can be managed, but they're spread over a period of time. The third way to do that is to monetize those debts. In other words, to create the money and to use the money to offset those debts. So the ability to do those things very much depends on whether one's debts are in one's own currency or in a foreign currency, and whether one's creditors are domestic creditors primarily or foreign creditors. So I've been through many, many debt adjustments. I should say that in most cases, they're painful but healthy. At the time, they don't seem healthy, but sometimes there's a redirection of spending. For example, in real estate, quite often debt crises come from real estate. We had that in the United States, 2007 and 8. There are elements of that are true in China now. But that debt and that is being restructured could be used to finance excessive amounts of waste or a bubble. And it is best to do that restructuring so that those resources can be redirected to finance better uses of capital. But the restructuring process, when it is in one's own currency, can be managed well. And there's a description that I provide in the book about a beautiful deleveraging. In other words, a balanced deleveraging. A deleveraging which is neither deflationary and depressing, nor very inflationary. And the way that that happens is by balancing those forces. For example, if you default on the debts and you have losses, that's deflationary. Because people sell assets and their buying power, their net worth goes down, and that's a deflationary force. If you print money and monetize those debts, that can be inflationary. Whether it's inflationary or deflationary depends on whether the amount of money created offsets the amount of credit contraction. But maybe I'm getting a little technical. What I mean is that by balancing those influences, one can do a debt restructuring in a way that is neither inflationary nor deflationary, or neither depressing or operating that way, or too inflationary, too stimulative. So that is the mechanics of that. If you apply that, if you use that template to think about, is the total amount of money and credit that is being produced in that currency increasing, in other words, the spending power increasing in order to more than the production of goods and services. So the amount of spending increase is greater than the amount of production increase. When that happens, that's inflationary. So you're seeing that particularly happen in the United States now. In other words, there was a downturn, and there was a desire, a need and desire to put money, a lot of buying power, in the hands of people and businesses and governments. And as a result, a lot of checks went out. And as a result of the fact that, where did those checks come from? The central government can collect money from taxes, and it can send money in terms of spending. But in the American system, it cannot create money. The central bank can create money, but it can't send it out and determine where that goes for the most part. And so you saw the central government produce a lot of debt, and the central bank produce a lot more money. And as a result, it's contributing to an inflation. And by inflation, I don't mean just inflation in goods and services. I mean also inflation in assets, investment assets, because what a recipient of that money can do when they receive it is to buy goods, services, or financial assets. In the case of China, there's more of a balanced adjustment taking place, in which the terminology is irrigate, not to flood, and we're seeing that kind of an adjustment take place. But in both cases, the currency, the debts are in their currency, and that way they can be well managed to produce a beautiful deleveraging.
So given the current level of public debt in the United States, how difficult is it for U.S. policies to bring down debt now? As you just mentioned, that there are 4 levers to bring down debt, and that they should use the right mix of these 4 levers. What would be the right combination of tools for them now?
Well, the challenge is there enough spending or not? And when there's not enough spending, you either tax the money from one group to pay for the other, or you print the money. And so the trade-off really becomes that. Taxing is a politically difficult thing to do because it takes it from one group to another, but it doesn't devalue money. The printing of money has the effect, when it costs more printing than there is the production of goods, it has the effect of devaluing money. So the trade-off can't be looked at just in a financial way. It has to be looked at in a social way and a political way, because to not produce the money has a consequence. So there's always some entity which is going to pay in terms of the transfer of wealth. And when it's done in a way where there's a lot more debt creation and printing of money, in other words, putting a lot of buying power in the hands of the recipients, that gives them buying power for the time being, but it also raises the inflation rate. So the trade-off is the difficult question to answer. Because interest rates are now near zero, that is much more difficult. There are three types of monetary policy I describe in the book. Monetary policy 1, monetary policy 2, monetary policy 3, as I call them. The first type of monetary policy, mostly, and the preferred type of monetary policy, is one in which there's the movement of an interest rate. So as you change the cost of money, that rations demand and it controls that. But of course, when you hit zero interest rates, that ability to ease from there cannot be achieved by materially lowering interest rates. Then you go to what I call monetary policy 2, which is also called quantitative easing, which means that the government, the central bank, I'm giving you the most common, there are some other tweaky ways, but most common. The central bank then creates money and then makes the purchases typically of financial assets, most commonly bonds, sometimes mortgages. And that means that they make those purchases from those who are holding bonds and financial assets. And those sellers typically are investors who want to continue to own investment assets. And so that type, monetary policy 2, usually results in those sales of financial assets leading to purchases of other financial assets and causing financial asset prices to rise significantly. When that happens, that may not pass through to the population as a whole, because those who have money, have financial assets, then invest in those financial assets, they go up, but they may not get to the people who it's not targeted for, maybe people who are most in need of that money. Monetary policy 3 results in the central bank, the central government, taking that and writing out its checks and sending the checks to those they believe need it most. So they direct that spending in a way that the central bank doesn't when they're pursuing monetary policy 2. And that when they go to monetary policy 3, the government does send out the checks to those who need it, and the central bank monetizes that kind of debt. So that's the nature of the mechanics and the trade-off.
Okay, so prior to the pandemic, you had already warned that we were nearing the end of the long-term debt cycle. So I'm wondering whether the pandemic now has any impact on where we are in the long-term debt cycle.
Yes, it accelerated its movement, because you can judge that by the printing of money, the amount of money printed, the amount of debt and money creation. You can't raise living standards by printing money. At the end of the day, you have to print, you have to make goods and services. That's what raises wealth. And so that has to do with a number of the policies in China, which are to operate in a way where there's more of a fiscal guidance to policy and somewhat less of a monetary policy for policy. Because if you have a monetary policy, you can easily give away money and have people spend more money, but it comes with a cost. And it's really because of credit and debt that we have these cycles. A typical cycle, you want to stimulate demand through monetary policy. You do things that stimulate creation of money and credit. And you give people more money and they will spend more money. But that, of course, means that that credit is somebody's asset. And if you pay that back in hard money, then that means that there's a depressant in the future, a stimulant today and a depressant in the future. And so that's why most cycles that you see, expansions and then slowdowns or recessions, are due to the creation or the restriction of money and credit. The policies now increasingly in China are to move to try to direct that through a steadiness of spending, and a steadiness that comes from fiscal policies. And when I mean fiscal policies, I include all government policies that affect spending, and to try to smooth out that cycle and not make it as dependent on the credit cycle.
So the IMF projects the U.S. economy to grow 6% in 2021 and 5.2% in 2022. So are you seeing a good, solid recovery in the United States? And what do you think of the fundamentals of the U.S. economy now?
We're in a very classic short-term debt cycle in which there was an enormous amount of fiscal and monetary stimulation. A lot of checks went out and a lot of stimulation happened when there was the plunge in the economy. And so a lot of that has gone out. And then, of course, from the highly depressed levels, the economy rallied strongly, and it's encountering its cyclical constraints. In other words, unemployment rates are low, demand is high, money is plentiful. So we are in the second, on our way to the third year of the expansion. That's the middle part of the expansion. What that means is that as inflation pressures rise, because there's more money and credit chasing a limited number of goods and services, because there are constraints, that produces a higher level of inflation. And when that produces a higher level of inflation, that then leads the central bank to leads the central bank to tighten money and then start to curtail the creation of money and credit. And so what you're seeing is we're moving into that phase. That phase will mean a reduced number of purchases by the Federal Reserve, and also the beginning of interest rate rises. That phase of the cycle usually goes on a bit, because touching the brake on the economy and raising it does not immediately cause a reduction in demand or credit growth that is enough to stop the economy. So you start to see that tightening. I expect that we will start to see that tightening. And then with that tightening, it'll start to have an effect. The effects come first in the markets and later in the economy. They come first in the markets because all markets reflect the existing level of interest rates. What an investment is a lump sum payment for a future stream of cash flows. And that stream of cash flows, in other words, you put up a certain amount of money, $100, and then you get a certain number of dollars back. And that might be 1 or 2% per year, and that comes back. And the markets reflect that. They calculate what we call present value, which means when they're looking out all that stream of payments, they look at an interest rate and then they adjust for that interest rate. The higher that interest rate goes, the more asset prices have to go down in order to provide a corresponding yield. So when interest rates rise faster than is discounted in the price, that causes the financial asset prices to decline. It also makes credit more expensive. And that is what curtails the demand. And when that demand is curtailed, that is what produces the slow up. It is a very difficult thing to do now because there's a lot of debt outstanding. There's a lot of assets are priced. Because of all the liquidity, assets are priced fairly high. And so there's a greater interest rate sensitivity than is normal. But that's the cycle. And so 2022 will be, I think, an adjustment period as you start to have that touching the brakes, but not turning that into an unacceptable downturn.